Hello everyone. Today I'm going to present about the effectiveness of monetary policy in addressing economic crises. For the introduction, monetary policy is the action and communications of the central bank that manage the money supply. Money offers include forms of credit, cash, checks, and money market mutual funds. The most important of these forms of money is credit. So credit includes loans, bonds, and mortgages. Monetary policy is a policy adopted by the monetary authority of a country that controls either the interest rate payable on very short-term borrowing or the money supply, often targeting inflation or the interest rate to ensure price stability and general trust in the currency. Unexpected changes in the exchange rates for better monetary policy reactions to achieving low inflation targets. Motivations of study. There are three objectives of monetary policy. The most important is to manage inflation. The secondary objective is to reduce unemployment, but only after controlling inflation. And the third one is to promote moderate long-term interest rate. Methodology. The Taylor rule is a model of interest rate forecasting created by famous economist John Taylor in 1992 and outlined in his 1993 study, Discretion versus Policy Rules in Practice. This shows how the central bank should change interest rates to explain inflation and other economic conditions. The Taylor rule indicates that the Federal Reserve should raise rates when inflation is on target or when gross domestic product GDP growth is too high and over potential. This also indicates that the Fed should lower rates when inflation is below its target or when GDP growth is too slow and below potential. The Taylor rule calculating monetary policy is as shown in the slides. To calm nominal Fed funds rate, real federal funds rate usually is 2% plus rate of inflation plus 0.5 times target inflation rate of inflation minus target inflation rate plus 0.5 times rate of inflation minus target inflation rate. Data and results. If there is a significant lower correlation between money supply during the recession, this could indicate that monetary authority loses its effectiveness during the recessions. In order to determine that, the correlation coefficients for periods in recession and for periods out of recessions are separately calculated. In Figure 1, we can see that the variables money supply for different countries have different movement pattern. For most countries and for most of the analyzed time, they have tendency to grow in tandem. For Argentina, it can be noticed that both variables starts its exponential growth at the end of recession in early 2003. In Croatia, we have a stable but not exponential growth of these variables from 2000 until the beginning of the crisis in late 2008. From 2008 till the end of analyzed period, we have stagnation of money supply and slower growth of money supply, 0. In Lithuania, the growth is significant from 2001 all the way down 2007 when a recession started, as well as a significant decline in both variables. After the recession, both variables started to grow again. Switzerland had an almost constant money supply variable until the beginning of the recession at the end of 2008 and slow growth of money supply 1 variable. In this diagram, the most significant changes in the movement and relation between money supply 0 and money supply 1 can be seen for US economy. Namely, figure 1 shows a strong growth in money supply 0 at the beginning of the recession and not so strong response of money supply 1 growth. This descriptive statistical analysis shows that all distributions except Croatia M1 have a long right tail. In addition, the distribution Croatia M0, Lithuania M0, Croatia M1, Lithuania M1, and Switzerland M1 of view are peak relative to the normal, while the distribution Argentina M0, Switzerland M0, USA M0, Argentina M1, and USA M1 are flat compared to the normal distribution. As a conclusion, this research shows that in a period of crisis, monetary authority hampered controlling the movement of the money supply. The reasons for that we can find in changed behavior of banks and non-banking sector, households, and businesses. As a conclusion, this research shows that in period of crisis, monetary authority hampered controlling the movement of the money supply. The reasons for that we can find in changed behavior of banks and non-banking sector, households, and businesses. Namely, in periods of crisis and uncertainty, banks are reluctant to grant the loans to households and to businesses as well because of increased credit risk and because the deterioration in their balance sheets. Additionally, because of rising unemployment and fear of job loss, households' demand for loans stagnated, and in the same time, they start to withdraw money from the bank, causing the bank crisis. The overall result of that is the increase of currency to deposit and excess reserves to deposit ratios, and consequently the decline of money multiplier and money supply. That's all for me. Thank you very much.